name is Tim Craighead, and I'll be moderating today's webinar. I'm the Senior European Equity Strategist for Bloomberg Intelligence and one of our research directors looking at global content and thematic issues and marketing and whatnot. And it's actually absolutely my pleasure to be with you all today and to be hosting today's discussion. Before we get into the talk, let me give a little bit of background and touch base on a couple of housekeeping items. First and foremost, I want to make sure that we give due credit to Evenco and what they're doing in terms of this Trend Watch webinar, as well as their in-person fund forums. This is actually the 11th Trend Watch webinar. It's been an ongoing series of topical discussions with CIOs, strategists, asset allocators, fund selectors, etc. And they're always, I think, a very interesting, timely, topical debate and conversation. There's another one actually scheduled coming up on September 28th that will look at ETFs and passive investing that promises to be intriguing. The fund forums that I had mentioned, these are the in-person events that bring together funds and fund selectors to learn about new investment opportunities, as well as share thoughts and ideas on topical issues of the day. There are upcoming fund forums in Geneva and Zurich on September 27, 28, and through the rest of the year, the road show continues, if you will, with Frankfurt, Milan, Lisbon, Paris, Edinburgh, London, etc. So do stay tuned, look into these events. I think you'll find them quite easily on the Evenco website, and come and check these out. From a Bloomberg Intelligence perspective, I'd say that we've had the good fortune of working with Evenco on well over a dozen of these over the course of the past year. It's been an opportunity for us to offer our thoughts on the market outlook and moderating some really excellent panels. And for reference, Bloomberg Intelligence, if you're not familiar, is the investment research arm of Bloomberg. We've got 500 or so professionals now around the globe covering all markets, sectors, 2,000 companies and credits. And if you have Bloomberg, you got us. We'd love to have a conversation. So with that having been said, as far as the webinar goes, we'll look to have this conversation over the course of the next, call it 40 minutes, give or take. If you have questions along the way, please feel free to pop them into the chat that you see with Zoom. And we'll see if we can't pick some of these up, but we've got plenty to dig into. The topic, navigating volatility and capitalizing on economic recovery. I think this is a perfect time to be talking about this sort of construct, coming back as many of us are from summer holidays, thinking about the macro backdrop, thinking about how to position and allocate assets, whether it be region, sector, thematic, as we look into the year end, and importantly at this point in the year, starting to think about 2024 and beyond. To do this, we've got 4 very knowledgeable and experienced panelists to join us. We'll start with just a brief intro, so we can provide some context to the discussions that we've had. Caroline Simmons from UBS Global Wealth Management, do you want to give us a little bit about you?
Sure. Hi. Thanks very much. Hello, everyone. So I'm the UK Chief Investment Officer for UBS Global Wealth Management. That means I'm the person on the ground in UK representing our global house views. My background is in equities as an analyst originally, and then I was a strategist on equities and on real estate. Looking forward to the discussion.
Yeah, that's super. Edward Smith from Rathbones.
Sure. Good afternoon, everyone. I'm Co-Chief Investment Officer of Rathbones. My occupational background is as an investment strategist and economist. My academic background as economic historian, and I've got responsibility at Rathbones for asset allocation, fixed income, risk modeling, cross-asset strategy, as well as joint responsibility for the evolution and performance of the central investment process.
So a bit of everything. Let's go to Joe. Joe Little joins us from HSBC Asset Management.
Yeah, thanks a lot, Tim. Thanks a lot for the introduction and for having me. I'm the Chief Investment Strategist for HSBC Asset Management. As you mentioned, what that means is that I lead the macro and investment strategy research function. We've got a global team, and the purpose of that is to support investment decision making across our portfolio management teams globally. And also, I do a lot of work around client communication, sharing our house view, meeting with investors. So super happy to do a little bit of that today with you.
That's super. And last but certainly not least, Patrick Sonner joins us from Swiss Re. Patrick?
Hi, everyone. Thanks for having me. I'm the head of macro strategy at Swiss Re, and in this role, I shape the global economic views as well as the interest rate views for the group. I'm also a member of the Asset Management Investment Committee. I and the team are also responsible for alternative scenarios and these types of things. Prior to joining Swiss Re, I was a couple of years at the World Bank in the public sector in Washington, as well as at the Swiss Central Bank. And I'm sure Caroline will be pleased to know that I initially started my career as an apprentice at UBS. So that's that. Thanks for having me.
Absolutely, that's super. Look, let's jump into things. We'll start this discussion with a little bit of perspective on the macroeconomic outlook. It's a great place to start. We don't want to spend the entire time on this, but without talking about this, it's harder to put into context where we dive in from allocation and thematics and what have you. So, we all know we've been through a massive central bank tightening cycle through Western economies. And yet at the same time as, central banks have been fighting inflation, we've had fiscal spending on infrastructure that's been quite powerful. We've had pent-up savings from the pandemic, especially in the US, that has been at the forefront of muting the economic impact so far of all of this tightening. Looking ahead, where do you all and your firms think we're at from the standpoint of the economic cycle, the inflation cycle, the interest rate cycle? I know that's a lot, and you can cherry pick where you might want to focus. But why don't we start with the economic historian? Edward, do you want to jump in on this one?
Yeah, sure. I mean, so if the peak impact of a central bank rate change is felt after 9 to 18 months, which is the standard time period from the literature, then it's important to note, right, that 18 months ago, US rates were still at 0.5%, and 9 months ago, they were 4% compared to today's 5.5%. There are some reasons to think that the lags may operate at the longer end of that historic range today, longer maturity corporate debt profiles, for example. And so we are only now really entering what I'm calling the midnight zone. We've also had a major tightening of commercial bank lending conditions, which tend to lag by about 9 months. And again, that means we're entering the midnight zone there. And there's never been a soft landing when central bank rates have surged and bank lending standards have tightened as well, if we look back a few decades. Now, that doesn't mean it can't happen, but there's information in that, right? And so you mentioned excess savings causing the economy particularly the US economy, to be more resilient, certainly in the early stages of rate rising. Well, in nominal terms, there are still some excess savings left to spend, but do people think about their savings in nominal terms, or do they think about them in inflation-adjusted terms? Do they think about what they can buy with their savings? Because in real terms, those excess savings are largely gone in the UK, in Europe, and in the US. for all but the richest 10% cohort of Americans, real savings fell below the pre-COVID trend in Q1. So those excess savings are really a matter of perspective at the moment. Seen in real terms, their exhaustion could be now a weakness, and US consumer resilience will be tested by resumption of student loan payments in October, which could take between 0.4 and 0.8 percentage points out of consumer spending, all other things equal. Real wage growth is likely to slow as labour market tightness shakes out, and we do expect unemployment to rise. Now, on the other hand, the ISM is ticking up, new housing is ticking up, consumers could go on spending. So we've got a 30% probability on a soft landing, but our base case is a disinflationary recession with an eye on some of the inflationary risks. So perhaps I'll hand over to some of my peers on the panel to comment on those other aspects of the cycle.
No, that's super. Who wants to jump in? Whether it's economics or jumping into inflation and interest rates, who wants to raise the hand?
I'm happy to go. So a couple of observations. I do think that we are late in the cycle. I do think, and that is also our baseline outlook, that over the next 6 months or so, the recession risk will be very elevated and the situation quite precarious. Now, with regards to inflation, it is very clear that we are past the inflation peak on headline and on core inflation, but that doesn't mean inflation momentum is resolved. And particularly for longer term investors such as Swiss Re or the insurance industry overall, this is a very important topic to debate, because whether we ultimately settle in the medium term at an average inflation rate of 2.5% versus 1.7, 1.5% that we had witnessed over the past decade, or basically post GFC, that makes a very big difference for real money investors such as ourselves. So that is something that we are watching quite extensively. Regionally, we believe the recession risks in Europe are more pronounced than they are in the US. For a variety of reasons. Edwards had mentioned the monetary tightening cycle and the associated bank lending standard, and that is particularly potent in a bank-based economy, an area such as the euro area.
No, fair enough. Caroline or Joe?
Yeah, slightly less negative outlook perhaps from me. We also think we're nearing the end of the cycle, but we're not assuming a full-blown recession for the US. Definitely growth slowed down and growth, close to zero, Q3, Q4. But we think probably skirts around a full-blown recession and then gradually recovers next year. UK and Eurozone, the outlook is a bit weaker on the economic front. But what that means for us is we think we're near the peak on rates. So for the US, we think we're probably there. UK and Eurozone, probably another rate rise still to come. But we are already seeing, obviously, inflation falling, particularly in the US, very quickly. And that wage growth is turning positive, or real wage growth is turning positive in many regions. And that, by the time the full feed through of the monetary tightening has come, the consumer should be feeling a bit healthier.
Joe, what about you all's thoughts?
Yeah, thanks, Tim. So I mean, look, the honest answer is waiting for this recession is a bit like waiting for Godot, isn't it? It's felt a bit like that. We've heard the recessionistas forecasting a slowdown all year. We're still twiddling our thumbs, looking at some resilient macro data, particularly in terms of profits, which has remained rather resilient, and particularly in terms of the consumer side of the story, connected maybe to some of the points around fiscal stimulus, excess savings, which you and Edward have made. So I guess my feeling is that Godot will eventually arrive, unlike in the play. In this case, the recession Godot will arrive. And I think the reason for that is that the headwinds for the consumer are building around the tightening of credit conditions, the softening that we're seeing in the labour market, which is a real thing. We can see that in the data, particularly some of the leading indicators on the labour market. And the idea that excess savings, which has protected the consumer so far, are pretty much exhausted now. I tend to agree with what Edward was saying. So the main issue for me is that you've got these impacts which take time to come through from a really aggressive rate tightening cycle, the most aggressive rate tightening cycle that we've seen since the 1980s in the US or in Europe. And it is a bit like the analogy that Milton Friedman famously drew of controlling the economy is like staying in a slightly down at heel hotel, and you're using the shower in the hotel room, and the controls are a bit antiquated. So you try and put the thermostat, the temperature up to hot, and it's scalding hot. You're turning it back down, and it's freezing cold. Controlling the economy with monetary policy is a bit like that. So when you've put interest rates up rapidly by over 500 basis points in the US, I think those long variable lags inevitably create a problem further down the road. And we're getting closer and closer to that point. So yeah, 6 to 12 month time frame, I think we're looking at a recession. I tend to agree with what Caroline was saying as well around the divergences globally. I mean, Eurozone and continental Europe and the UK looking a lot more like stagnation. It's a much trickier situation there with the deterioration that we've seen in the growth data already. So maybe the soft landing is even bumpier there. The softish landing is even bumpier there. And of course, maybe Tim will get a chance to talk about China as we go through the story or the sequence of the discussion today. But I mean, it's not so much a landing in China as a bumpy restart. So it's a slightly different set of optics around the macro growth, inflation, policy story in China. But yeah, that's the way we would see the world at this point.
No, that's cool. And I would comment that our Bloomberg economist, Anna Wong in the US, is very definitively on the recession starts in 4Q and continues into early next year from a US perspective. And has been holding to that view pretty vociferously, and it's consumer driven for all of the reasons that we mentioned. And I did think it was interesting. She highlights that there are some intriguing sort of short-term amorphous factors like the Barbenheimer effect, which sounds kind of crazy with those summer blockbusters, but it boosts spending. And the same thing, crazy as it is, with Taylor Swift and Beyonce both being on concert. And you start to add these little things up and talk about some of the factors that you all have mentioned, you end up with a bit of a hangover by the time you get to 4Q, with those little things this summer having actually exacerbated what will be the comparison going ahead. But not to belabor it, nobody has yet talked much about how far down inflation recedes, which I think is another pretty critical factor to think about. We've had the sort of 3D thesis for a while about decarbonization and deglobalization and demographics, all changing the structural perspective of the inflation outlook. So yes, we do see inflation receding, but we don't see it going back to where we were pre-pandemic. Any quick thoughts on the inflation outlook that anybody wants to throw out?
I think Tim, from my perspective, it depends a little bit the time frame that you're thinking about. So I have in mind a zigzag for the inflation trajectory. The disinflation pressures, I think, are still under acknowledged by the market at this juncture. The speed at which we're going to begin to now see core services inflation also falling, assuming, of course, goods inflation remains well contained. We're watching that oil price move of recent days quite closely. Commodities remain a key factor. Food and energy remain a key factor for the inflation story. But my assumption really at this point is that disinflation is the big story, and a risk of deflation, a deflation scare on a 12-month time frame. So this time next year, maybe we have another session. Maybe the Jackson Hole conference is worrying about some of those downside risks on the inflation, undershooting risks on the inflation target. But I think as we extend the horizon a little bit further, then maybe some of those structural factors that you mentioned come back into play, because I think we're going to end up with somewhat higher inflation, or maybe an acceptance that we're going to be overshooting inflation targets on a repeated serial basis. more into the medium term, so that 18-month plus sort of time frame. And that's a function of some of the elements that you mentioned, the transition to the green economy, the regreening of the economy, the shift to the multipolar world, which is profound in terms of its effect for the economy and for asset allocators, and some of the other issues that you mentioned already also. So I think it depends a little bit about the time frame that you're thinking about, but near term, the disinflation process is the critical thing, I think, to emphasize, and it doesn't preclude some of those more persistent inflation forces coming back into the medium-term picture, which means that the 2020s on average look rather different to the sort of growth inflation mixture that we saw in the 2010.
Oh, fair enough. Anybody want to add any other thoughts on the inflation front before we move forward?
Yeah, I think I'm hearing a lot of strategists at the moment talk about labour market tightness in the US getting back to 2019 levels. And don't get me wrong, that is a really noteworthy development, but that isn't just sort of kick back, inflation's going to be fine, because 2019 levels of labour market tightness were still quite tight, right? They did not relative to the subsequent sort of few years that we've just lived through, but certainly relative to history, 2019 was tight. And who knows if COVID hadn't come along in February, March 2020, if that level of tightness would have actually led to some much more significant wage inflation. So the reason I bring that up is that we definitely think that our base case is a continued fade in inflation, but we're not sort of ready to sort of rub our hands together and say, well done, central bank's job done just yet. On those longer term outlooks, look, our 10-year view is that we're in an inflation environment of 2 to 3% rather than 1 to 2%. So we're not in the camp that we're going through a seismic shift, but actually that increase in inflation does make a difference to us as asset allocators, which I'm sure we'll come on to later. And the reason why we think we're in a 2 to 3 inflation world rather than a 1 to 2 are we subscribe to the view that demographics is inflationary, although there's a lot of debate on that. We're not really fans of the deglobalization thesis. We think globalization is reorienting around different hubs, but not necessarily deglobalizing. And globalization wasn't as disinflationary as a lot of people assume in the first place, if you look at some of the economic studies. So why do we think we're higher? Well, we think more volatile commodity prices at the margins will make more of a difference now, as well as a couple of other structural factors. But yeah, that's our view.
No, fair enough.
Maybe briefly, if I may.
Yeah.
I mean, I very much agree on many of the points. Our view is also around the 2 to 3% structural view, primarily driven by a lot of the deficits that are expected in the US as well as the Eurozone. And I think a lot of the deficit expectations are reasonable, and they're not overly conservative or benign. So I do think that will be a structural inflation factor. But I think the other point with regards to asset allocation implications is that if you basically shut down the global economy as a result of COVID, you overstimulated with fiscal and monetary stimulus, you open up the global economy again, you not only have a shift of inflation higher, but you also make inflation volatility higher compared to the prior episode. And that is important because ultimately inflation stability allows you from a portfolio perspective to much more easily calibrate which asset classes should be favorable going forward and what are the mitigating strategies, how are central banks going to react if you see a structural trend that is inflationary or deflationary. And if you have these commodity spikes, for example, that Edward's also alluded to, a lot of these traditional approaches just become immediately a lot more multidimensional and a lot more difficult to navigate for asset allocators. So I think it's not only a level issue, but really also a volatility issue going forward.
I think that's a really important point, actually. That regardless of your view on the level of inflation, right? I think it's pretty consensus that difficult to dispute that inflation won't be more volatile, and that alone means that if you're in multi-asset portfolios, you need to work harder on your diversification asset allocation, because there will be more times when your fixed income diversification just doesn't help you out. And that volatility alone could also skew the level, because inflation can spike by 10%. It's pretty unlikely to fall, but to have minus 10% disinflation, right? There's an asymmetry to inflation volatility.
Fair enough. Well, why don't we shift gears into sort of the next chunk of the discussion? If we have that as a macro backdrop, what are you thinking from an asset allocation perspective? You know, it's like the new buzz phrase. You know, it shifted from, you know, there are no alternatives to there are reasonable alternatives. So Tara is here, not Tina. And if you have that as a possibility, what do you think about equities versus fixed income versus alternatives? You know, however you want to frame this. Caroline, do you want to jump in on this?
Sure, thanks. I kind of wish I was coming up with the acronyms rather than the investment strategies. But yeah, I mean, longer term, obviously, we've got this sort of growth inflation backdrop that is not dissimilar to what the other panelists have outlined. So longer term, we think equities generally outperform. But over the next 6 to 12 months, we're neutral on equities. And we have a preference for fixed income. And that is a combination of factors. One is the valuations, particularly around the US equities, which we do think look reasonably expensive, with the equity risk premium now being below its long run averages. Not so the case in Europe or in the emerging markets, so it is a bit different by region. But fixed income, on the other hand, looking quite attractive and offering the best valuations and the best yields that it has done for many, many years. So with a sort of that is the valuation backdrop, then the earnings essentially is linked to nominal GDP. Nominal GDP is falling, so one would expect earnings to fall. And we are seeing it in some regions, but not all regions. And so we're favoring the regions where we think that has already troughed and bottomed.
No, fair enough. Who else wants to jump in on this? I'd like to hear from all of you all.
Yeah,
I'll go on, Edward. You go first. I'll go after you. How about that?
Okay, that's very kind, Jay. Thanks. Briefly, so we're overweight high quality fixed income. We're still neutral on duration. Actually, there is a slight nuance to that view, and because we still think there are some inflationary risks, and the carry and Sharpe ratios at the shorter end of the curve don't warrant us to move to a longer duration mindset. But I would say this: I've been at Rathbones for 9 years, and this might be the first time that we are so overweight fixed income and even benchmark duration. And I think that just shows the shift in the new environment compared to the old playbook of the last that we got used to in the 2010s. Then quickly, I think risk asset pricing, particularly among US cyclicals, is complacent, and I don't think you have to believe a recession is coming, like me or like Patrick, to think that. So macro data points are providing conflicting signals about the likelihood of a US recession. The average of forecasters is a bit different to the average of this panel. I think it's roughly 50-50 odds of one over the next year. It's changed a lot since the end of last year. The corporate bankruptcies are already at a 13-year high, right? And we're only just entering the period where the effect of rate hikes are likely to be felt most intensely. Whether they will or not, you can debate. But that's this huge uncertainty, right? And yet the VIX is near a 3.5-year low. US investment grade spreads are nearing the most expensive quartile ranking historically. Parts of the equity market are very expensive, some perhaps justifiably, some less so. I think there's complacency that you should guard against, regardless of whether you are fully in that recession camp.
Oh, fair enough. Joe?
Yeah, thanks. Look, the way I think about it is it's not so much soft landing, hard landing, recession, no recession that's going to matter in terms of market dynamics here. It's the extent that that news flow confirms or challenges the prevailing consensus that's discounted into stocks, credits, bonds, other asset classes. So the real issue for me at the moment is how there's this pervasive acceptance of the soft landing, that the Fed have panicked. They've put up rates 550 basis points in a very short period of time, the fastest tightening cycle since the 1980s. And it just so happens that they've got everything spot on in terms of the calibration of policy. There's not this Friedman thermostat panic in the shower as we're scalding and freezing ourselves sequentially. So you look at the confirming evidence, real yields, tips yields, 10-year tips yields, almost at 2% now. The 5-year pricing higher for longer in bond markets in the US and in other global bond markets too. Stocks re-rating themselves. Semiconductors leading the story, classic outperformance of broad equities, confirming risk appetite, risk sentiments, very strong cyclicals, outperforming. Wherever you look, it's that sort of evidence of the soft landing, the benign outcome, the immaculate disinflation, as some people have begun to call it. Now, look, that can proceed for a little while. Momentum's a very strong, powerful force. FOMO is a strong, powerful incentive for investors in the near term, particularly if the data, the coincident data, stays okay. But I just feel that we've traded that inflation reversal so well, and I don't know that it can last in an environment where earnings is pretty lackluster. In fact, some real big question marks about whether or not we see a more decisive shift lower, a bigger profits recession at this juncture, and the move in the discount rates. I mean, I agree with Caroline. The equity risk premium is falling quickly here. Stocks are re-rating themselves. Everything that we've seen this year is about multiple expansion in stock markets, and that's occurred at the same time that the tip yield is moving higher and higher. Nominal bond yields are moving higher and higher. Economists are adjusting their estimates of the equilibrium interest rates, the so-called R star. It's quite a big adjustment in discount rates here. It's not setting us up for great performance. So we would be cautious, defensive in terms of our asset allocation. There's still some things you can do in stocks, but it's a quality focus. We're a bit more focused on places that are maybe a bit less loved. Japan in stocks, or some more defensive, selective areas, maybe valued as okay. In a high, choppy, sticky inflation environment. And small cap is an area which has discounted a lot of bad news, which might be worth a look. And as Edward has mentioned, bonds are back. I mean, I think emerging markets is also interesting. I know that's not quite what you asked at this point, Tim, but one of the big challenges is where you find diversification. And there is a huge opportunity to find diversification in parts of frontier and emerging markets at this juncture for investors. The idiosyncrasy that we see in the behavior of global stock markets is really quite intriguing and marked at this juncture. So you need to be a bit creative in how you're building portfolios at this juncture. The old rules don't work, and the outlook for the stock market is tricky given how much has been built into expectations so far this year against a tricky outlook for fundamentals, I think.
No doubt. Patrick, how do you feel about the allocation idea?
So insurers in general are very fixed income heavy investors as a result of regulation and the business that they're in. So a typical insurer, particularly property and casualty, has maybe 80% of total assets in fixed income. And it's really a sea change compared to a couple of years ago. Bonds really are back. I mean, if you look at, for example, an investment grade all-in yield in the US right now is roughly 5.7%. That is double than what you would get at the end of 2019. So if you are a fixed income heavy investor, this is a great environment to deploy capital. In nominal terms, in the euro area, we've seen a similar, even more dramatic upswing on a relative basis, but also in real terms, actually, the inflation compensation that you get right now in fixed income is at the very least a decent one, depending on your inflation outlook going forward. It's a very good one. So yeah, maybe the the boring bonds aren't so boring anymore. So I think it's a good good environment for fixed income heavy investors. With regards to going out the risk curve and so on, again, because we are just very wary of the recession risks and what Joe had alluded to, it doesn't even need to be a recession, but just a recession scare, right? A reassessment of the recession risk of the market. Investment grade, in my view, just has a better, a more resilient outlook compared to high yield at this juncture.
Yeah, and I would mention that within the context of our global scorecard work that we do within our equity strategy team within Bloomberg Intelligence, we're now favoring emerging markets with a bias towards LATAM and Europe, excluding the UK, quite notably, as the next stop, and the US as the last stop on the hit parade. Part of this is various earnings trend. Part of this is valuation considerations and whatnot that go into our scorecard work. So not dissimilar in some ways to some of what you all have talked about. And we've had an interesting sector sort of skew as well from the standpoint of some of those cyclical groups, Joe, that you had mentioned, relative to some of the more staple or defensive areas. But why don't we shift to a few investment themes to talk about a little bit. I'm conscious of the time here. One that we can't not talk about, to use the double negative, generative AI. It's all the hype. We've talked about the US market doing what it's doing, and Lord knows a lot of that is AI and technology oriented. I'm sure all of you all are well aware. You take the S&P 500 versus the equal weighted S&P 500, and you have a very, very different picture. And you have a multiple of 19 times on the one hand versus 15.5 on the other. So it's a high-powered story. Is it overhyped? Is it real and going to continue to drive the U.S. market? Any thoughts on what you think about the theme, or how you all are looking at this as an investment theme to either take advantage of or be risk averse about? Who wants to jump in on this one?
Joe mentioned earlier the phrase FOMO, and you particularly see FOMO playing out in investment themes, right? And particularly themes oriented around new technology. So look, I think generative AI could get much more overhyped, right? Think of radio stocks in the 1920s or internet stocks in the late 90s, or if globalization is a form of technology, think about the miners and the oil dominating the 20 largest companies in the world in 2010, right? Who are now nowhere near the top 20. These things always get over extrapolated. This could run and run, but ultimately I do think the valuations, even among some of the highly cash generative magnificent seven, those so-called 7 biggest US tech companies, do look a little unsustainable at a time when there are just so many questions around the impact of generative AI being glossed over, right? So if generative AI is a game-changing general purpose technology, it could conceivably boost GDP by 1-2% a year, maybe. But from when? Like, no one knows if that will kick in next year or in 10 years' time or in 20 years' time, because there are long lags, right, between technological invention and adoption. Often you need to wait for complementary technologies or a hell of a lot of organizational and capital to be invested in trying to figure out how to use these things. And productivity booms tend to follow a period of supernormal investment spending. And the question now then is, will high interest rates, high levels of indebtedness, and high uncertainty around inflation constrain the necessary investment spend for you to get that productivity boom? Another question that I really don't see people thinking hard enough about is there may be some negative social and economic side effects from generative AI displacements that require more government spending, and therefore will governments actually tap tax the beneficiaries more, and so will profits post-tax actually be boosted all that dramatically after all? I could go on with a whole list of questions that are difficult to answer. So look, I think if you're investing in a theme, you've got to diversify at this nascent stage, invest across the technology stack, from the chip makers to the architects and the hyperscalers, as well as those companies actually applying it. And on the latter, we're exploring some innovative ways to build diversified baskets, actually using AI itself, actually.
Oh, very good. Anybody else want to jump in here? Caroline, Joe, Patrick?
Yeah, I've got a few comments. I guess in a way, on a tactical basis, we've made a bit of a call on this, in that we have a preference for equal weighted US over broad-based US. So that is essentially, stripping out those, or the bias anyway, of those sort of 7 largest stocks, which are predominantly tech stocks, and some of them specifically viewed as the AI sort of plays, if you like. So, I think short term, we probably have seen a little bit of a sort of an overhype, but longer term, the potentials, as we were saying, are so big, over the longer term, that you don't want to rule that out if you've got a multi-year time frame. But in the short term, we've had probably a lot of the new technologies we get, each one seems to have a quicker adoption cycle. AI is probably going to be one of the quickest so far, but you do need to have that investment that comes with it. And then there'll be a period of consolidation, as I was saying, to see what actually comes out at the end. And so I think we will go through that little period of time to see what comes out before we benefit in the longer term. And, we can compare this a little bit to some of the other areas of tech, like green tech or something. That was the big hype. Everyone was all decarbonization. It all did brilliantly. It got a bit expensive. Then it kind of collapsed and underperformed, but long term still has great potential. And in fact, tactically, we quite like it again. So, these things are not just sort of going to outperform over every time period. You need to sort of be careful about what you're thinking of.
It reminds me of the old McKinsey hype cycle sort of thing. And are we at the ultimate hype right now, potentially? But nonetheless, I would reference, and this is an unabashed self-BI plug, we put out a pretty large piece on the trying to size the overall market on AI. And I would absolutely agree with what has been said already from the standpoint of, maybe a little ahead of itself, but longer term, there's some big opportunities. We sized it at 1.3 trillion in incremental revenue that's oriented towards AI across the tech stack broadly, as I think Edward had sort of outlined. But pretty interesting work. Happy to share that if anybody is interested. Not to not have Patrick or Joe talk about AI, you're welcome to, but why don't we broaden this out, since Caroline, you sort of took a bit of a tangent on other themes like green tech that you're intrigued. What themes do you guys, gal, find interesting at this point as you look into the rest of this year and importantly into 2024? Any big ones on your hit parade? Joe, do you want to jump in on this?
Yeah, happy to, Tim. I think we haven't talked about emerging markets. So look, if you're looking at a high octane, high beta asset class, a point of economic pain, deliquification, economic recession in the West, it doesn't sound like the most attractive time to be focused on the high octane, high beta emerging market asset class. So maybe you have to pick your spots. But the story in China and in Asia generally is quite interesting to us. When you talk to investors around the world, I think a lot of investors are finding it very difficult to be positive about developments in China at the moment. There's a challenge around confidence, consumer confidence very weak, confidence in the housing market very, very fractured as well. But the point I would make is that the policy options do exist in order to support the situation and begin the process of turning the story around in the minds of investors. And that's important because in the context of the very depressed and rather attractive looking valuations that we see at this juncture, being too bearish might not be the right approach. Sentiment is very depressed, ownership is very limited. That can be a good starting point for some good return profile for the market. So some of these areas, China, Hong Kong, equity markets, quite interesting areas to focus on. South Asian markets as well have been a big structural story. So we all focus on India because of the great Goldilocks economic situation currently and the strong structural story, particularly around agriculture. You mentioned greening, energy independence, lots of very good stuff going on. But Indonesia, people don't talk about Indonesia, even some of the frontier markets, Nigeria or Egypt as well. These are going to be the big leading economies of the world by the time we get to 2060, 2070, 2080. So I think that they're really interesting stories. And what's super fascinating, to pick up something that was mentioned earlier about diversification, is how idiosyncratic some of these stories are. If you look at the correlation between Chinese stocks and Indian stocks, I mean, there's no correlation at all. And yet, if you go back to your textbook, everybody says, oh, equity markets, yeah, they have a strong correlation across all equity markets around the world. 50%, 60%, 70% correlation. They're all integrated markets, except they're not. In a multipolar world, you've got policy cycles, economic cycles, structural development strategies, which are doing quite different things around the world. And it means that some of these allocations, it's idiosyncratic. It's not a fire and forget sort of strategy. You need to be active and nimble and selective. But looking at some of these stories, both cyclical, tactical, and structural across emerging markets and frontier markets, really interesting at this juncture because of that idiosyncratic source of return that it might be able to provide for portfolios.
Patrick, thoughts on this one?
Well, we are insurance investors are, I would say, less adventurous than many investors that are here represented on the panel. So these are all obviously things that we monitor. But I think for us, for example, sustainability, climate change, ESG, these are all topics that are close to the industry's fundamental value proposition and where we have a really key role to play. So these are a lot of the topics that we continue to pursue going forward. Now, clearly, all the other topics that have been mentioned, we do look at them, but the capital allocation and particularly the regulatory framework often inhibits, how far you can really go in trying to expressing that view. So I think at this juncture, it's also important to kind of reflect what has worked well the last couple of years, because we have gone through a very unusual cycle, and what are the learnings in terms of portfolio construction and so on, so that you can hopefully draw the right conclusions going forward.
Oh, very good. And Edward and Caroline, you all really oriented the sort of thematic comment about AI. How would you sort of take that farther afield? Caroline, you want to go first?
Yeah, so we've done quite a lot of work on sort of longer term themes generally for quite a few years. And the approach that we think is best is a diversified approach, because you don't really know who's going to be the longer term winner. They might not even exist yet. But also that you want to access through the whole value chain, because there are different elements that go into creating the output, and they have different valuations and they have different cyclicality. And so if you're investing in this longer term trend, you want to be in the whole range of the sphere. So, the industrials who are, building whatever, the factories in which the chips are, in which the data centers are, you want to have the whole range of the offering, not just the pure AI sort of generator, if you like. And that's the approach we take for all of our longer term themes. And it does seem to generally play out better, because you get a smoother valuation input and a smoother through the cycle experience. So, when you're talking about AI specifically, you need to be thinking about sort of, the enablers of this sort of 5G, internet penetration, hardware, software, and then its uses, education, all the different sectors to which it could apply, not just the tech space.
Yeah, fair enough. And Edward.
Well, definitely, let me answer it from a portfolio construction angle, because I definitely agree with Caroline's thoughts that it's very difficult to spot sort of 10 years in advance what the big themes are going to be. So hedging bets is a good idea across some super themes. What I think is important for investors to look out for, though, is that when you're then accessing the diversified baskets of themes, you're not actually inadvertently loading up on just one or two risk factors, because especially if you access these themes indirectly via funds or ETFs, they're often overweight the same stocks, right? You often end up just with massive overweights to Google and the major tech stocks. Or what you end up doing is that a lot of the idiosyncratic risks are diversified away, and you just end up with a massive exposure to the growth factor, right? Which you don't need to do a bunch of whole thematic work and do that to access, right? You just go out and buy a growth ETF and probably effectively get the same thing if you're not careful. But we think thematic investment as an extra lens, as an extra analytical lens is really important, but you have to be quite careful about how you then translate that into your multi-asset portfolio construction processes.
No, very good. Look, I know that we have gone through an awful lot here today. So I think, from the standpoint of timing, we'll probably bring things to a close here, having looked through the macro, having looked into allocation and investment themes. Clearly we could carry this discussion on for a good while. So I do appreciate all of you all's time, your thoughts, your insights. Appreciate all the people who have dialed in to listen and will listen to a replay. And we look forward to the next Trend Watch on the 28th and the events in Geneva and Zurich to come. So thank you again, much appreciated, and thanks Evenco.